Fox Business Alert: bond traders and investors are marveling at the retreat in the 10-year Treasury yield. Friday, it closed above 4.4%. Right now, it's at 4.27%, down nearly 13 basis points on the session. Market watchers are crediting, in part, President-elect Donald Trump's selection of hedge fund executive Scott Bessent to head the Treasury Department for this pronounced drop. The yield dip could be a bet that Bessent, seen as market-friendly, might dilute some of Trump's stated policies, namely tariffs, that many economists fear will be inflationary. Bessent has urged a gradual approach to the implementation of tariffs. But joining me now is somebody with a critical vote in the Federal Reserve's interest rate strategy starting this January, Chicago Federal Reserve Bank President Austan Goolsbee. Austan, welcome to the show. Thanks so much for being here.
Thanks for having me back. It's great to see you.
Great to see you. What camp are you in with the Bessent nomination? Sigh of relief or hold up, we don't know yet?
As you know, you become a member of the Federal Reserve, you're out of the fiscal policy business. So I'm merely observer.
You're observer, but you're observing 10-year yields cratering, basically. I mean, if you look at how many basis points it has dipped over the past week and a half, but certainly since the announcement of a more potentially moderate Treasury Secretary when it comes to tariffs, it's pretty interesting, isn't it? I mean, and yields have been climbing even after the Federal Reserve in September dropped rates by half a percent.
On the short rates.
Yeah.
Yes, look, if you take a step back and you compare yields now to what they were in the spring, so you take a kind of a longer view, there hasn't been as much movement as there's been a lot of volatility in the short run. For the group that thinks that was mainly driven by changes in expected inflation, my only observation is we have market measures and estimates of what expected inflation is going to be, and you haven't seen the movements nearly as pronounced in inflation, so that's probably not the main reason. I think part of the long rates, of course, are they embody a path of what they think the Fed is going to do over time. So as the market starts changing how fast or how slowly they think the Fed is going to be cutting rates, that's going to affect what the level of these longer treasuries are going to be. So I wonder if there's a little bit of a reflection problem partly in that, too.
Well, is there a question, do you think, about what happens in December? We have the final meeting for the Federal Reserve in just a couple of weeks. If you were a voter, what is the important message you would send to the markets when voting for another rate cut?
Well, look, you know I don't like tying our hands ahead of time before we get all the data that we're going to have and before I've heard what the other members of the FOMC, what they have to say and where their opinions are. That said, I think the longer through line over the last year has been inflation's coming down, the unemployment and the job market has cooled to a level that looks pretty sustainable. That's about what full employment is, and that's why, as I look at the dot plot and what all the members of the FOMC say they expect for rates over a year, by the end of 25, I think rates go, if conditions continue like they have been continuing, rates go lower than they are today. And whether that takes place in December, takes place in January, how fast that happens will be determined by the outlook and the conditions. But the through line to me is pretty clear that we're on a path, and that path is going to lead to lower rates closer to what you might call neutral.
Is that the right move? Because we're getting a bunch of data in the next couple of weeks. But if we look at the data that we have gotten, for example, we're waiting on October PCE. That's the personal consumption expenditure. It's the Fed's preferred inflation gauge, particularly the core. The expectation month over month on the headline is like a gain of 0.2%. That's pretty calm. Year over year, up 2.3%. Core, though, up 0.3%. Year over year, up 2.8%. I mean, September was hotter than expected on just about every metric. Are you concerned that if you continue to cut rates like this, that inflation could actually rear its head?
Look, everything's always on the table, and if the economy looks like it's overheating, then the Fed has to deal with that. Now, I've been a little skeptical that this is what an overheating economy looks like, and I just caution everybody on inflation. That's a noisy series. It's up, it's down. We take longer averages for a reason, because we don't want to overconclude anything from 1 month's data. I think the broad through line has been the newer months of inflation coming in oftentimes below what was expected, but not that far above the 2% target. And thus far, barring some change, I feel that that's the path to 2%. So conditions and outlook will adjust the speed at which we do this, but barring some sign of actual overheating of the economy, I still feel comfortable saying that if you look at the broad dot plot, rates have a fair way to go down before they will get to something like neutral. And if you've got inflation coming toward the 2% target, and you've got unemployment rising but getting to something like sustainable full employment, you better be careful adding cold water to the bathtub if you got the temperature about where you want it.
All right, I get that. But if we're looking at rates right now, they're at 4.5% to 4.75%. That's the Fed funds rate. Where's neutral? I mean, how much lower do you need to see it go before you're comfortable?
Yeah, I mean, you only know neutral by, as the chair said, by its works in the economy. And there are some lags to monetary policy, so you can't just do that on a monthly basis. That, hey, we got 1 month's numbers, and so we know. I think that if you look at the dot plot, there's a range of estimates, let's call it, projections.
But where are you?
I'm closer to the median on those. Whether you're on the higher side or the lower side of where it's going to settle down, almost everyone agrees that it's well below where we are today. So as we get closer to where the disagreement is about what's the settling point, I could see that it makes perfect sense to start slowing the pace of the rate cuts. But I don't really see, barring some convincing evidence of overheating, I don't see the case for not continuing to decline, but to have the Fed funds rate decline, because everybody agrees it's well below where we are today. So until we start getting into the range of where people think is the settling, I still feel like this trajectory that's the way it's leading us.
All right, that's news. Well below where it is today, and I say that because to hear it from you directly, we are waiting just to see what inflation looks like come the October PCE, and we're going to report that right here. It's going to be a big deal for the markets, I'm sure, no matter how it comes in. Austan, great to see you.
Yeah, great to see you again, Liz.
Happy Thanksgiving.